Schlesinger, editor-at-large of CBS Money Watch. I'm joined by
Jack Otter, executive editor, and it sounds like you almost forgot your own title that time.
Yeah, I almost did. I wasn't hearing myself in my headphones,
Oh,
so
okay.
I was waiting for Sally and the Cracker Jack board to kind of come up and running. So
Gotcha.
there it was.
Okay.
What is my, oh yes, editor-at-large. Anyway, you're here with Ask the Experts, and quickly log in to moneywatch.com so you can check us out and join the live chat. We have not one but two guests today,
This is
Jack.
exciting.
It's
Yeah.
very exciting. So let me start with, in the studio, we have Larry Swedger, who writes the Wise Investing blog for us at Money Watch. He is a principal and the director of research for the Buckingham family of financial services. And he's authored like 112 books and writes a lot. Now, that's about it. I mean, he's very prolific. So
And he does a lot of research, too.
a lot of research, very wonky, kind of cool. Anyway, and we had someone who writes a book called The Quest for Alpha. That's not a science fiction book.
No, it's
It's a
not.
pretty wonky dude. We are also joined by Liz Weston. And I'm sorry, you can apologize to your husband. I will not use that last name, that married name. It's too hard to pronounce. Weston's easier.
Weston is my married name. It's
Oh,
Holton.
oh.
That was my.
Well, apologies to your parents then. Forget about it. I'm not done. I'm done with it. I've tried it. I can't do it. So tell your husband I'm in. Liz Weston is an award-winning, nationally syndicated personal finance columnist. Her columns run twice a week on MSN Money, another website I've heard of. It's not ours, but, you know, whatever. Her question and answer column, Money Talk, appears in newspapers throughout the country, including the Los Angeles Times, the Palm Beach Post, which I understand she only likes to have the syndication so she can visit.
Yeah.
That's probably it.
Keeps the office there.
Portland Oregonian, Stars and Stripes, and others. She writes a money column, My 2 Cents for AARP. It's the largest circulation magazine in the world?
Yep.
How about that? 22
And getting bigger.
22 million. I'm not in it yet. I'm going to be, I mean, I'll be psyched to get better prices on movie tickets, but I'm not there yet. Let's see, she's written 4 books, not as many as Larry's 112. A whole bunch of them. Anyway, 2 very smart money people. We're very excited to have them and want to thank everyone for making the effort to come here today. Let's just start for the top. Pretty boring day, actually, in the markets, Jack.
Yeah.
You know, mixed, blah, blah, blah. Nothing's going on this week. It's a boring week. I can't even blog about anything.
How
It's
can
so
you
boring.
even say that on the week when the Fed releases its beige book findings? I mean, the very name, beige book, tells you how exciting that is.
Yes, it's
Yeah.
good. It's like gray meat. Same thing. Larry, they say that things picked up a little bit in the end of the year. Fed said, all right, things were pretty good. So how are you feeling about where the economy's standing right now?
Well, typically what happens is just when investors are abandoning hope and they think the only light at the end of the tunnel is a truck coming the other way, and that's when they bail out, and the markets, of course, probably turn around because valuations are low, meaning expected returns are high. So that's what happens.
And Liz, in your experience with people who are writing you and asking you questions, are people feeling a little more upbeat? Or do you sense a little shift here, or is it maybe not as good as we'd like to think?
I do see a little more optimism, but I'm still hearing from people who are just giving up on the markets, just saying, I can't do this anymore. It's just too tough. I was on Marketplace Money talking to a 60-year-old woman who completely sold all of her equities. And we were trying to talk her out of it, but she's just like, no, I've had enough. I don't want to do this again.
I just want to point out a very exciting studio moment. Jack couldn't hear anything in his headphones because his headphones were not plugged in. So that is one of those things where you actually need to plug in your headphones to hear things. And I think, are you missing the
It
connection?
turns out I'm missing a connection, yep.
So you're not going to be able to hear Liz, is what
No.
I think is going to happen. I will tell you what Liz says. We will. You know what? This is live, and we
Oh,
can
wow.
make this happen.
Like the game of telephone.
It's fantastic.
Yeah.
You'd be surprised.
Liz will say buy index funds, and you'll say, I think you'd be better off with managed futures, Jack. And
No, I wouldn't do that to you. Let's start off and get some user questions. Jody in Pennsylvania starts that. She says, I'm 46 and I struggle to figure out how much I should have saved by now for retirement and what I need to contribute to be on track. Now, there are a lot of calculators out there, and it's a little daunting, and lots of variables. Jody wants to know the simplest equation or method. What do you think, Liz? What's the easiest method besides inheriting it, which is always, to me, the absolute simplest one?
You forgot marrying it. You know,
Marrying
that's
is a little more complicated. Inheriting, I think, is cleaner. Yeah. Mm-hmm.
You know what? I really like T. Rowe Price's retirement income calculator. It used to be all about, projecting your income in retirement. but they have now a portion where you can look at what you should be saving. And she's the perfect age to go in and take a look at it. troprice.com/RIC, Retirement Income Calculator. And to me, it's the simplest way to get started. I know there are other rules of thumb, but I'm just a little leery of those. I think I like the Monte Carlo analysis that T. Rowe Price does. I think they make it simple and understandable for most people without dumbing it down too far. So that's where I'd send it.
Oh, that's cool. You know, another one that I found, and I can't remember who told me to check this out. It may have been Mark Miller, the retirement guy. There's a site called choosetosave.org. It has this very cool thing, and I have it up on the screen. Oh, Megan, you can't put it up on the screen. You don't know what you're doing. Megan's in the back. This is chaos in the studio today. I swear to God, she did it. Okay, hold on. It's up on the screen, and Megan is like high-fiving herself right now. Ballpark estimate. I think this is kind of a cool thing because I agree. I like the T. Rowe Price one. Vanguard has a little bit more. First of all, you can barely find it. But besides that, I think that this is kind of interesting. There's an interactive tool. What about this idea of all the variables, Jack? People are like, well, I don't know. What's my expected return going to be? What do you think is the right number?
Well, that's what I was going to say. That's the crazy thing about these calculators is they ask you what the inflation rate's going to be for the next 30 years. They ask you what your returns are going to be. I mean, if I knew the answers to all those questions, I wouldn't be using your calculator. So, I think there are a couple things you can do. One is you should play with these things and check out different scenarios. If you want to look for an expected return, the Jack Bogle method on stocks is to take earnings growth, which he pegs around 5%, add in the current dividend, and say that's your nominal return. Yeah, so that would take us to around 7% a year, but that's before inflation. And then they ask you to plug in that inflation number. Right now we're under 2, but that's unusual. So I don't know, stick 3 for inflation, 7 for stocks. Bonds, your expected return has to be very low because yields are so low right now. So maybe bring your overall expected return down to 5%. See where that gets you. I suspect it will scare your pants off.
Yeah. Larry, what do you think about
those are
numbers?
reasonable rules of thumb, and the problem is you have to know what your asset allocation is going to be. That's one thing, how much you have in stocks and how much you have in bonds as well. So if you're going to be 20% in stocks, getting 7%, and 80% in bonds getting 2 or 3, you're obviously going to get a lower expected return than if you're the other way around. You're more likely to get that number, but it'll be a lower number.
Yeah, exactly.
I like using 5% return. I think that's kind of a good, boring number. And I would even use, depends how old you are, but I might use like 4% inflation.
Wow.
But
okay.
but that's like if you're under 40. Because I think that going forward, where's inflation going to go? I mean, nowhere in the near term.
There are no good forecasters of inflation. That's what the research shows. But the consensus forecasts of economists and the market itself, which you can look at by looking at Treasury inflation-protected securities, is only about 2.5% for the next 10 years. So that's something to consider as well.
And one thing I would say is even while we can talk about how it's hard to predict these things, but actually going through the motions of giving it your best guess is a heck of a lot better than flying blind.
That's true.
And I would add one other thing with inflation. The higher inflation goes, over the long term, stock returns will go up with it, and lower inflation returns will go down. So you need to keep that in mind. Bonds won't protect you from inflation unless you own those Treasury inflation-protected securities.
Well, which leads me to a question from Keith, who wants to know the safest investments for his 401k to keep pace with inflation. Now, you talked about TIPS, or Treasury inflation-protected securities, which are kind of not a great deal right now. But what about going out long term? Maybe Keith's in his mid-40s. What would you do? How do you keep pace with inflation? You said stocks is one area.
Stocks is one, but in the short term, they're so volatile, they don't protect you from anything. And of course, stocks can do very poorly over a long time. So the only really good inflation hedge, the best one is TIPS. The second best is some short-term, safe fixed income, because as the maturities roll over and they come due, you get the higher rates if inflation goes up. The third one, and I'd only put a small allocation to this, not gold, which has no correlation with inflation. It could do very poorly even if inflation goes up, contrary to what most people think. but a broad-based commodity index, because commodities themselves are a source of inflation.
Yeah.
So something like the Dow Jones Index or the Goldman Sachs Index, an ETF may be based on that, or a mutual fund.
And a great way someone explained it to me once was that, when you have inflation, basically the dollar is shrinking. And if your yardstick is getting shorter and shorter, the stuff it measures is getting longer by comparison. And so that's what happens with commodities and inflation.
Yeah, right. Commodities are highly correlated with inflation, and the longer the time period, the more likely it is that they'll correlate well.
All right, let's just do a quick here in the chat room. If you want to log into the chat, go to moneywatch.com, and are they going to find it on moneywatch.com? Yeah, okay, figured that much. And you can join the discussion. So Stephen's asking our outlook on gold and silver, GLD and SLV.
Well, he's come to the right place, Jill
Yeah.
Schlesinger.
I don't know. I'm going to tell you this. These are not, as Larry just said, this is not about an inflation hedge. This is about a panic trade. That's what gold is all about. Like, you're really panic stricken, some small percent in gold. That's fine.
Gold hedges geopolitical risk,
Right.
not inflation. For example, 1980 through 2003, inflation averaged 4%, more than doubling. Gold dropped 70%. So
Yeah.
clearly gold's not a good inflation
right.
hedge.
And with silver, it is more of an industrial metal. So if there is some economic growth and there is some steam in the economy, you'll see it. So, Stephen, look, calm down. I mean, everyone's trying to find the bottom or the top of these markets. If you want to have a little bit, 2-3% allocation.
Maybe even 5 is
Yeah,
okay.
it's okay. But I like your idea of doing a commodity basket. And I'm a long-term oil bull. So I'll just say that.
And I would add this, you should have a target, whatever that is, your 3% or 5%, then you rebalance. That means when commodities are roaring, you're taking some of those chips off the table, those profits, and then when it does poorly, you get to buy cheap, and commodities are very volatile. So you get to benefit from that, buying low and selling high. Exactly the opposite, Jill, as we know most people do.
That's right. Okay, Liz, let's get back into your world here. I know that you've had a zillion questions like this. First is, this is about the mortgage refi and the HAMP and the HARP and all these crazy acronyms, which, frankly, who could keep up with it all? But let me start here. Ria in Maryland says, once you've received a loan modification under the HAMP program, can you turn around and sell your home within the next few years with no adverse effects? Do you know the answer to that, Liz?
I do not know the answer to that. That's a really good question. My understanding is that you can sell at any point.
That's what I thought.
If you're deeply underwater and dealing with the short sale, it might be more complicated. You might want to go to HUD.gov. They have a list of HUD-approved housing counselors, and they're doing a pretty good job of keeping up with all these different programs and the implications. And I would go to them first to ask these kind of questions.
And Liz, is the OCC still have that help with my bank.gov where you can report your bank for not working with you on the HAMP or the HARP? Are they still doing that or not? Because that was like a program that was up and running, which was like, hey, you tell us if your bank's not working and playing with you. Remember that Elise Glink told us about
was all
that.
over that, yeah.
And I went to the site today, and it was sort of like a more generic, like, if you have a problem with your bank, but any bank, like, the Gloria, the teller, was mean to you, it felt like. So, it was just a very weird thing where there was a much more specific area dedicated to the whole mortgage modification market. I didn't see that anymore. So what's happening there?
I think with most regulators, like with the FTC, if you have a problem with the company and you report it to the FTC, you're not going to get individual action. They're basically going to wait to see a pattern emerging and then act upon that. So I don't know that even if you, were able to lodge a complaint there, that it would do much good in terms of your own individual situation. That's why I keep coming back to the HUD counselors. At least they keep up with the programs. They can serve as kind of an intermediary. They can help you deal with some of the issues. But the reality is a lot of people have been trying to get modifications. A lot of people have been trying to get refinances. The banks are losing their applications, losing their paperwork, and really nothing much is being done about it right now.
I will say with the OCC, one of the keys is to get an OCC case number.
Right.
And that'll help you a little bit in fighting that fight with the bank.
Well, listen to this email from Stefan, who says that he called his mortgage company on several occasions about refinancing an FHA loan through the program. And I was told on 3 different occasions I didn't have an FHA loan. And that is maddening. That's like, let me put my head against the wall repeatedly. I knew I did, and I finally had someone assigned to my account. She told me I did, in fact, have an FHA loan. I sent the package in twice. They claimed my account was frozen in their system because of a computer problem for months, in caps. Months! Now they're asking me for the paperwork again, all caps. Can I do anything about this? What can you do? What can you do? I mean, this is maddening for people.
You know, this, I would love to grab Elise and ask her if anything is effective in dealing with these kind of situations, because I know she's been seeing the same kind of complaints I have of people just running into these brick walls over and over and over. And sometimes, you know, when you really find yourself in a corner, you might turn to your congressman and say, can you do anything about this? But, you know, at this point, there's so many complaints and so little being done. I don't know that I can offer much hope here.
Yeah, I think this is a pretty rotten situation. We don't have a program, any program. And I, before the show started, Liz and I were talking about the new program, which was supposed to be sort of like HARP and HAMP version 2.0, 3.0. And it was supposed to be a program that would remove the cap on the loan to value, right? And it was going to eliminate new appraisals, and it was going to have a lot of things it seemed that were missing in the old program. But Liz, what's up with the new version of mortgage modification?
Well, it's just being rolled out, so it may be a little too early to say. But what I'm hearing from the mortgage experts, the loan officers I'm talking to, the brokers, is that they're still having trouble finding a lender willing to do a refinance for more than about 105% loan to value.
Wow.
So that's not even the 125% that the old program was supposed to help. So I don't know that taking away the limit, and I mean, the big deal was giving the lenders some more reassurance that these loans wouldn't come back to bite them. You know, they did change the rules on that. But so far, haven't really seen the lenders stepping up to say, yeah, we're going to help you out. So, you know, initially there was a lot of enthusiasm and some idea that maybe this could be helping people, but I'm not sure that it's going to roll out that way.
Yeah, Jill, I was vice chairman of the largest mortgage company in the country at one point, and to me, there's a very simple solution. I don't know why it hasn't been adopted. Anyone who's really underwater and capable of paying, they should be allowed to refinance. And now, because the government has the credit risk anyway, then what you do is you put in a clause where if they sell it, then you share your profits with the government, who's now taken over the risk. That would remove all of this overhang of loans that are underwater, and the mortgage companies would save a fortune, because taking possession can cost up to about 25% on average of the property. So all of that would go away. This has been suggested by Nobel Prize winning economists. I don't know why the government isn't listening.
Is what would happen if for the second position on a deal like that?
Well, they get wiped out.
That's why it's not happening.
But that's what should happen. That's why they got higher yields in the first place.
I
That's
know.
the risk they took. They're going to get wiped out anyway if it defaults.
I think they don't want it on their books now. I think this is a case where that's why short sales are so hard, is because they'd much rather put it off rather than basically mark to market.
Well, and a mark-to-market approach would force it to happen.
Yeah.
It would be the best thing. And you cannot kick this can down the road. The more you do, the longer the problem exists. That's the crazy part. We need to bite the bullet, and then the housing market, I think, would recover fairly quickly.
Yeah.
And you know, we are experts at kicking the can down the road. Larry, I got a question here. A user says, my company 401k match is given in company stock. I hate that.
Right.
I actually
agree.
think that
It should be illegal, in my
It should be
opinion.
illegal. How is that
Absolutely.
part of an ERISA rule? It's
Right.
ridiculous.
Yeah, I
Okay.
completely agree. I write about this all the time.
It's like, okay, so I have quite a bit and I need to sell it.
Right.
Should I do it all at once? Sell it over the next several months? For what it's worth, the stock is currently performing well.
Right. Whatever the stock is doing is irrelevant. I have a simple rule here. Just ask yourself, if God handed me the money and I didn't own any stock, what would I do with it? And the answer is clearly you wouldn't buy this stock out of 3,500 U.S. stocks you could buy and 10,000 international, and the odds are close to zero. On top of it, you're doubling your bet because you're working there. So if you work for Enron, you lose your job and your pension. So it makes no sense. The answer is obvious. You should sell it immediately.
All right. I love that answer. You know, I had...
Could you please call my wife?
And then diversify it, put it back in the market, but then own some kind of broad-based index fund or a group of them, so you can own 10,000 stocks around the globe and get rid of the single stock
Well,
risk.
this brings up a very funny thing that happened. Somebody at CVS asked me to look at his portfolio, and I said, okay, you've got a ridiculous amount of money, 40% of your net worth in CVS stock. And you're not a kid, you know, you're 58 years old and you got a lot of risk on the table. I said, but it's doing so well. But
So was Lehman Brothers or Bear Stearns.
And what about CBS when it was not doing so well? When so you went down, you wrote it from 30 to 4. Now it's back at 28. And he says, I just want to wait till it gets to 30 again. Come on.
Classic.
There's every kind of behavioral mistake in the book.
And that conversation.
They're confusing from the familiar with the safe. You know, people who live in Atlanta load up on Coca-Cola, but it's clearly not safer to own Coca-Cola if you live in Georgia, and it's not safer to own Enron if you live in Houston. I write 77 of these kinds of mistakes this person to read about in my new book, Investment Mistakes Even Smart People Make and How to Avoid. This is one of the classic ones.
Yeah, ridiculous. All right, let's get back into a quick question here. Liz, first of all, someone asked about the mortgage limits for Fannie and Freddie, and it went down over the fall to $625,500. That's correct, right?
I believe so.
Yeah, I think so. And so, one of the questions I have is that when you get people who say, is this a good time to buy a house? Now, what do you say to that?
Well, here's the deal. I've never believed in timing the real estate market. When all the cheerleaders were out there were going, yeah, it's time to buy, I wrote columns about, you know what, it's not the best idea for all people. And people went nuts. It was like, oh, but real estate is only going to go up. They're not making any more of it. It was really hard to get across the message that the best time to buy a house is when you're ready, when you're financially ready, when you're emotionally ready, not necessarily going to be a great investment, period. So if you're in a position where you want to be a homeowner, and I think you really want to, have to have that desire, you are prepared to stay put for at least 10 years because, it takes a while. We're not bottomed out yet. It might be a while before we see some appreciation. Even in normal markets, it can take a few years for a house to appreciate enough to offset the costs of selling it. So you want to be able to stay put for several years, and you can afford all the costs. And, if you only have a 3.5% down payment, I really believe you probably should wait. I think you should have at least a 10% down payment. 20% is even better. And not everybody is cut out to be a homeowner. So given all that, if you're ready to buy and you can stand to see the value of your house drop some more, then go ahead and buy. Because right now we have really low interest rates. We have, if it's tough to get a loan, but if you have a steady job and you've got that down payment saved and you're ready to buy a house, I wouldn't hold out, hoping that, well, maybe conditions will get better because, maybe prices will drop a little bit more, but maybe interest rates will go up. So again, I come back to when it's the right time for you to buy, you should buy, and you should be prepared to stay put for a while.
I couldn't agree with Liz more, but what most people don't know is that housing, except for a brief period from the mid-'80s to early 2000s, was a terrible investment, did not do more than keep up with inflation, where stocks were getting 7% above inflation for the last 80 years. We had a unique period where housing went into a bubble. Housing prices have collapsed many times, and they may collapse again. So housing should be thought of not as an investment, but a consumption item. And you should buy a home because you want to consume it, if you will. Think of it, you're paying yourself rent, if you will. Never treat housing as an investment.
Yeah, people thought they were getting these great returns because, their house inflated by so much. They weren't, factoring in inflation. They weren't factoring in how much houses cost, the maintenance, the property taxes, the insurance, all those ancillary costs were just thrown out the window. They were just looking at what they bought it for and what it's worth now. Since we've been through this housing deflation, we now understand that it can happen. And I hope people will keep that in mind going forward. When there does start to be some appreciation again, it's still not the best idea for everyone to own a house. It's just in certain circumstances, and again, you have to have the desire to do it.
People's memories are so short. We had housing price collapses in the oil belt in the 70s and 80s. We had oil prices collapse several times in California. We had a price drop in New York that was fairly sharp at one point. They happen. And they're going to happen again, so you have to keep that in mind.
The one thing I was going to say was that an economist once described a house as a piggy bank that you live in.
Yeah.
and I think that does get to a behavioral reason why houses actually can be a good investment. So Larry points out that stocks did 7% percentage points better than inflation for years and years and years. So clearly, if you were renting and putting all that money in the stock market, you would have done better.
Right.
The problem is people don't. They rent and they spend the money on sneakers and dinners and
Forced
cars.
saving.
Right. So by forcing yourself to save, then then at least you retire with this thing that you own, which is better than retiring in something that you rent and having no cash to show
And
for
since
it.
no one's saving for retirement, it'll be perfect because we'll all need reverse mortgages. Okay, here's the next question for you guys. This is from RC. I'm a 64-year-old single female with a very small amount saved in IRAs. Just got a small inheritance, $25,000, and so right now I want to know kind of what to do with it. I owe $6,500 on a credit card. Well, let's pay that off. Pay that off first. Now, what do I do with the remaining $18,500? Basically, she's moved to a new city. She's trying to know, should you need a financial advisor or not? I mean, this is not somebody who's got a ton of money. Larry, what does a person like this do, starting off?
Well, probably the best thing is to keep it safe. That would be one thing. You may want to go to someone like the Garrett Network of Financial Planners who are fee only, pay by the hour, because she doesn't have complex issues. Put her on the right path. But I would suggest pay off all your debts, credit cards, other things. And you probably don't want to be too much in the stock market anyway at her age, and with her amount of money, she has very limited downside. So that would be my advice.
And Liz, just going into the credit area here, Carolyn wrote us, how do you go about fixing your credit score? What are the best steps to take to increase your score? Best ways to dispute a rating from a retailer or a bank?
Okay, well, let's start with the dispute idea. You really can't dispute a credit score. It's calculated based on the information in your credit report. So go to your credit report, see if there's any errors there. And by errors, I mean serious things, accounts that aren't yours, late payments showing up when you paid on time, things like that. For most people, it's not going to be, they're not going to find too many serious errors. The problem is the stuff they actually did that are causing them problems, that the payments they skipped or accounts that got charged off. And only time can repair that. Paying your bills on time, paying your credit accounts on time is what's going to help. And take a look at how much of your available credit you're using, because that's incredibly important in the FICO formula. The FICO is the leading credit score. You want to have a big gap between the amount of credit you're using and your credit limits. And it doesn't matter if you pay in full, every time, which I hope you're doing. Whatever is reported to the credit bureaus is what's considered your balance. So you want to try to keep your credit utilization below 30% of your limit. Below 10% is even better. And then again, it's just time. People want the instant returns. They want immediate gratification. And that just doesn't happen with credit unless there's actually an error on your report that you're getting rid of. Typically, it takes a long time to recover from the stuff that you've done. So
Yep.
if you had any big setbacks, it's going to take a while to recover.
I would just add one thing that your listeners, may be doing they shouldn't. If you have any credit card debt and money in the stock market or in bonds, you should sell and pay off your credit card debt. You have no business, in effect, borrowing money to invest in stocks. Worse, invest in bonds, which are guaranteeing you a negative return.
But
Yeah.
don't take your retirement funds and do that.
Right.
You don't want to take money out of their retirement funds. That's just, on investments on the side. If you have savings or a stock or something that you could sell and pay off your credit card debt, absolutely, that's the way to go.
But I would add, before I put money into a retirement account even, I would pay off the credit card debt, especially if it's 18, 20%. You can't get those kind of returns in whether it's a retirement account or not.
Now, see, I disagree there because I think it's important to take advantage of company matches. I think you get
Yes, I would agree with that, Liz.
And the money can't be earning returns if it's not there. So I like people to be in the habit of investing for retirement, even if they're in the process of paying down credit
It's
card
like a
debt.
celebrity death match of personal finance people. I can't believe we got some drama here.
Yeah.
Woo-hoo. All right, last
I'll
question.
agree when you have the match.
All right. Okay. So here we go. Deborah in Denver. My husband and I have just told HSBC today that we will take them up on their offer for a deed in lieu in exchange for up to $5,000 to assist us in relocation and forgiveness of the amount now owed. This sounds like a good deal. When I spoke to them today, she says, they said we qualified for $4,500 and offered no explanation as to how this is determined and why it's not the full amount, the full $5,000. My concern is that though they were quite clear on the phone telling us what we need to do to get the money offered, they will not put it in writing.
Ugh.
Our questions are, Is this common practice with all mortgage companies? Is this an ethical way to do business? I don't think we like to use the word ethical in mortgage companies. I just think it's sort of silly. Let's just take that. A total oxymoron, exactly. What if they don't give us our money upon completion? Do we have any other options available? Though we obviously are not well-heeled financially, we are also wondering if we should hire a real estate attorney to complete this process. Larry, what do you think? They won't put it in writing. This is kind of scary. What do you think?
I would agree. This is just an area I'd prefer Liz take. It's not my area of expertise rather than guessing here.
All right, Liz, what do you think?
The fact that they don't put it in writing makes me a little nervous as well. I have heard of these deals going on. They want to try to short circuit the whole long foreclosure process, so they're offering you money to move out. Now, you have to weigh that against the fact that if you do go through that long foreclosure process, you can save up the money that you've been paying towards your mortgage. You don't have to pay rent. You just have to kind of wait out this rather difficult process before they kick you out. It's, whether that's worth $5,000 or $4,500 is kind of something you have to weigh. And given the fact that they're being they're being reluctant to put it in writing, I'd be itchy about this too. I'd want to talk to an attorney.
Yeah, I would agree. I would definitely talk to an attorney because.
And also, there's a great book out called The Foreclosure Survival Guide. I would read that before you do anything. Stephen Elias over at Nolo Press wrote this book, and it really is the go-to guide if you're in a situation where you can't afford your house. It talks about all these different possibilities, but I would want some legal help, even if you aren't well-heeled.
Okay, very good. Excellent. Dave writes in the chat room, I have a $25,000 home equity loan that's now in repayment at 3%. I could pay it off in full or pay $250 a month. Now, Larry, let's play out the scenarios. Let's say 3%, he's got a ton of money in the bank. He can just pay it off and write a check. Then we tell him to do that. But what if he has a portfolio, general investment account, a taxable portfolio? Pull money out of that to pay off a 3% home equity?
It just depends on what I think your need to take risk is and your ability. If you got a good stable job and 10, 20 years till retirement and then you're okay with the risk, you may want to do that, and that would be okay. On the other hand, you're a construction worker, an automobile worker, your income is unstable. I think I'd even advise them, even with the low rate, to be very careful, maybe not pay the whole thing down, maybe pay part of it, but I'd think twice about keeping stocks invested.
So what is the real cost of a 3% home equity loan? Do you have a deduction there too?
Yeah, you definitely have a deduction, though. Let's say that there's some portion
like
of interest.
2%
Let's
maybe.
even say 2.5%.
That may depend on whether he gets a standard deduction or not.
Right,
even,
we don't know. But let's just assume he gets a little bit of, let's say he gets a little bit of mortgage relief, right, from the interest deduction. But even that, listen, if your money's sitting at 0.5% in a money market account, then it's a no-brainer, right?
Right, exactly.
It's just a question about, I do think, Jack, that there is a sense that some people just would like to get rid of their debt.
Oh, absolutely. And it's tough to even quantify the sleep at night value of getting rid of debt. So I don't want to dismiss that. But if he, say, is not fully financing a 401k, remember, you could be putting 100 cents on the dollar into that 401k versus paying taxes on it. So let's say it's 80 cents on the dollar, then you pay off your loan with that. So I'd rather see him, at the very least, as Liz has been pointing out, get the match on the 401k. But frankly, I'd go farther than that and make sure he's up at 10, 15% into his 401k before paying this off.
All right, last question, lightning round, because there's a question from the chat room, but I'm going to change it up a little bit. It's from Jason. And Jason basically wants to know, talk to me about how the national debt and deficit affects this economy. I really and I think that we need sort of a quick, I know this is a down and dirty, but Jack, when you look at the overhang, the trillions of dollars of debt, not the near term, not even this year's deficit, the debt, the credit card bill, what's it doing to the economy? What will it do to the economy?
Interesting you should ask that question because this very morning, Megan and I were at a presentation where the woman at Schwab showed a chart that was actually put together by, is it Ken Rogoff and Carmen Reinhardt? Carmen Reinhardt has been a guest on this show. And it shows that when you have debt to GDP of over 90%, and right now we actually just hit 100%, it slows down economic growth. Pretty dramatically. You go down from an average historically for a developed country, I think of about 4.5%, down to more like 1.9, 2.2%. So it's really, really dramatic. The problem is there's no easy fix. You can't just say, okay, you know what, we're going to stop spending, because that would suck the life out of the economy. Not only would it be a short-term hit, but you wouldn't get the tax revenue that you need to pay off that debt. So the easy fixes that you hear about from politicians, they're politicians.
You mean a politician doesn't tell you what's really happening, Jack?
And I don't know if it's because they don't understand it, which I sometimes suspect, unfortunately, or they're giving you a line. And I'm not being partisan here. I mean, both sides have easy fixes, and frankly, both sides are wrong. What we need to do is we need to figure out how to keep growth up, which is going to generate tax revenue, which is going to bring down the debt, without, of course, spending so much that we just go farther into debt.
Larry, this morning, Germany said that Germany, by the way, the killer manufacturing center of Europe, right, the miracle of Europe, said, oh, whoops, we actually shrunk at the end of the year. The economy shrunk, and now they had growth of 3% for the year, which is pretty amazing anyway. But they shrunk at the end of the year. The debt weighs down lots of areas. How do you think it's going to affect us?
Well, first, Jack mentioned the debt is 100%. That's if you count the future Social Security obligations.
Right.
If you count it in the more normal way, it's about 70. So we're not quite there. But if you don't address the Social Security and Medicare, Medicaid, but you'll get to 100% fairly quickly. Within 10 years, I think the numbers are. We have good solutions, actually. The compromise that was put out by the President's Commission, which he threw under the bus, unfortunately.
Yeah.
Ryan has another plan. You may agree or disagree with parts of it, but we have solutions. The problem is this. As long as interest rates are where they are, we could sustain this debt because you're paying 2%, 3%, and the economy is growing 2 or 3 plus inflation. The problem comes if the markets stop lending you money like it's done to Italy or Greece, and now you're paying 7% and only growing at 2 or 3, now you will blow up very quickly. You get into a death spiral, then they start charging you more for money, and then force on you the draconian measures that are being forced on Greece, etc. That's the big problem. We need our politicians to step up, have the courage, say what needs to get done. We all know that we have to raise taxes, cut expenditures. Both of them have to happen. Why we don't do it, don't know.
And Liz, your last word, debt and the economy, how do you see it? Do you have a different view, a similar view? Where do you come from?
I'll follow right behind Larry. It has to be both. It has to be higher taxes and cut in spending. And we have to be careful about the cuts in spending because, as Jack said, we don't want to throw this economy right back into a recession. So it's not easy. And anyone who thinks it is lying to you. Also, you should look at yourself and say, what's my personal situation? I think we've been trying to protect our own situations for a little bit too long. All of us are going to have to make some sacrifices. All of us are going to have to give up something if we want to fix this issue. And I think that's the hard part, is that politicians know asking us to sacrifice is not a way to get reelected.
Well, if we don't make the sacrifices, the market will impose them. So it's not a choice. It's only a when, not if.
I agree with that, and I think that that's the amazing thing. Here's the good news, everyone. You're watching, you're worrying about this. Don't freak out. What's going to happen is this will happen. It is going to happen because at least we're talking about it now. Thank God, and to some extent, it's like it's bad enough that we're finally going to deal with it, right?
Well, the answer, I agree completely, is just look at what's going on in Greece and Italy. They never would have addressed their problems until they were forced to by the markets. Italy is raising the retirement age, cutting benefits, shrinking government. Greece is doing the same thing. It's only a matter of they doing enough. The same thing will happen here. There's no question. It's only whether we do it first or the markets force us to.
All right. Well, there it is. Your last word. Thanks so much for watching Ask the Experts. We want to thank Larry Swedroe, the author of the Wise Investing blog, and go find one of his millions of books. What's the last one called?
The last one's called Investment Mistakes Even Smart People Make and How to Avoid Them.
All right. And Liz Weston, what's your most recent book that I should plug?
Let's see, 10 Commandments of Money just came out in paperback, and Your Credit Score just came out in a 4th edition. So,
oh, my God. This is unbelievable. Jack's book soon to come out. Can't wait to plug that. We'll be doing
not
that.
worth it. Yep.
Exactly. And so, Jack Otter, any final words here before we wrap up? Great guest today, right?
Great guest, and I love that we have solved the nation's financial problems.
It's very nice that they just came to us more often.
Yeah,
Sad.
exactly.
Thanks so much for watching Ask the Experts. You can send us emails all week long, asktheexperts@moneywatch.com. We'll be back next week. And thanks for watching, and let us know if we need better music also, because Sally's been falling down on that. But, if you send us suggestions, we'll use it. Thanks for watching. We'll see you next week.